Every finance channel, every subreddit, every beginner investor guide, they all say the same thing. Buy VOO, hold it, don't overthink it. Okay, but what if you actually do it? What if you take $100,000, put it in VOO, and never add another dollar? Well, John did. He took $100,000, put it all into VOO. In this video, I'll show you what VOO is, how it actually works, what happens when the market drops 40% right after John invests, and why trying to beat this fund has cost professional investors billions. And in the end, I'll show you how VOO turns John's $100,000 into a multi-million-dollar portfolio. So let's start from the beginning. John's heard the advice long enough. He's got $100,000 saved up, and he finally pulls the trigger. Opens his brokerage account, types in VOO, and puts all of it in. Done. But now he's sitting there thinking, what did I actually just buy? VOO is the Vanguard S&P 500 ETF. Basically, one fund that holds around 500 of the largest companies in the United States. Apple, Nvidia, Microsoft, Amazon, Google, they're all in there. But it's not just tech. You've got JP Morgan, Johnson & Johnson, ExxonMobil, Walmart, 11 different sectors from tech, financials, and healthcare to energy and consumer goods. Basically every corner of the American economy sitting inside one fund. And that's important because if tech has a rough year, and it will at some point, John's not going down with it. He's still got healthcare, banks, energy, consumer staples all holding things up. One sector struggles, the other 10 keep working. That's not just diversification as a buzzword, that's actual protection built into the fund. And this thing is massive, over $850 billion in assets right now. To put that in perspective, that's more than the GDP of countries like Switzerland or Poland. More money sitting inside this one single fund than entire economies produce in a year. And the cost to own it? 0.03%. That means for every $10,000 John has invested, he's paying $3 a year. $3. Most people spend more than that on a coffee in a single morning. So now, John owns a slice of 500 companies across the entire U.S. economy for basically nothing. Cool, that part makes sense. But he's got another question. If it's so simple and all it takes is one fund and $3 a year, why does this actually work? There has to be something going on under the hood that makes this thing keep climbing through every crash and every crisis. And this is the part that most people miss. VOO isn't just a list of 500 companies that sits there forever. It's more like a machine that cleans itself. Here's what that means. The S&P 500 has a committee that reviews the list. If a company starts doing poorly, losing money, shrinking, falling behind, it gets removed, kicked out. And when a company is growing fast, dominating its industry, becoming too big to ignore, it gets added in. So John doesn't have to worry about picking the right stocks. He doesn't have to figure out when to sell a loser or when to buy a winner. The index does it all for him automatically. The bad companies get dropped, the good companies get promoted, and the great companies, the ones that just keep growing, take up more and more space inside the fund. Think about it. 10 years ago, nobody was talking about Nvidia. Now it's one of the biggest holdings in VOO. John didn't have to spot it early to benefit from it. He didn't have to time it. He just owns VOO, and Nvidia came to him. And it works the other way too. You remember General Electric? It used to be one of the most dominant companies in the S&P 500 for decades. Then it started falling apart. Bad management, bad decisions, shrinking businesses. If John had owned GE individually, he'd be stuck holding it, watching it bleed, trying to figure out when to sell. But because he owns VOO, the index reduced GE's weight, and eventually it was no longer a factor. John didn't have to make that call. The fund made it for him. Okay, so John gets it now. The fund cleans itself. It adapts. It holds the best companies in America at all times. In a couple of minutes, I'm going to show you how VOO turns John's $100,000 into a multi-million-dollar portfolio. But first, John's got one more concern sitting in the back of his mind. What if the market crashes right after he invests? And that's a fair concern because the market does crash. It's not a matter of if, it's when. So let's play out John's worst nightmare. Let's say he invests his $100,000 and the very next year the market drops 40%. That's not some made-up number, by the way. That's basically what happened in 2008. The S&P 500 fell 38.49% that year, the worst single-year drop in modern history. Let's say that repeats again. After the crash, John's $100,000 is now sitting at around $61,000. He's lost almost $40,000 in 1 year. Now imagine what that actually feels like. John opens his account and sees $61,000 where there used to be $100,000. His stomach drops. Every headline on every news channel is saying things are going to get even worse. His friends are telling him to pull out before he loses everything. His family is asking him why he put all that money in the stock market. Everything around him is screaming, sell. That moment right there, that's the moment that separates the people who build real wealth from the people who don't. Because John doesn't sell. He does nothing. He just leaves it. And here's what happens. The market recovers. It always has. After 2008, stocks bounced back. After the dot-com crash in 2000, they bounced back. After COVID dropped the market 34% in a matter of weeks, it recovered in about 8 months. Every single major crash in the history of the S&P 500 has been followed by a recovery. Every single one. And here's the part that really matters. The best days in the stock market, the days where the biggest gains happen, 76% of them occur during a bear market or right at the start of a recovery. In other words, the people who sell during a crash aren't just locking in their losses, they're almost guaranteed to miss the biggest recovery days. Miss just the 10 best days over 30 years, and your returns get cut in half. Think about that. 10 days out of roughly 7,500 trading days. That's one bad decision to sit on the sidelines every 3 years, and it costs you half of everything you would have made. Miss 20 and you lose 74%. Miss 30 and 84% of your returns are gone. That's all it takes to destroy almost everything you would have made. So John's only job during a crash is to do absolutely nothing. That's it. Don't sell. Don't check the account every day. Don't panic. Just let the machine do what it's always done. Recover and keep climbing. And if that sounds too simple, Warren Buffett bet $1 million on this. Literally. In 2007, he wagered that a basic S&P 500 index fund would beat a hand-picked basket of hedge funds over 10 years. And the bet started in January 2008, right before the worst crash in decades. Buffett's S&P 500 fund lost 37% that first year. The hedge fund lost only 24%. It looked like Buffett was wrong, but he wasn't. Over the full 10 years, his S&P 500 pick returned 125.8%. The hedge funds? The best one did 87%. The worst one did 2.8%. In fact, the hedge fund manager conceded the bet early because it wasn't even close. The smartest money managers in the world, getting paid millions using every tool and strategy available, couldn't beat the thing Buffett and John own for $3 a year. Now you know how it works and how it survives crashes. There's really only one question left. What if you invest $100,000 into VOO? So here we go. Let's run the numbers on John's $100,000. Remember, he put it in once. He's not adding anything. No monthly contributions, no extra deposits, just $100,000 sitting inside VOO doing its thing. After year one, John's $100,000 is projected to grow to $113,790, almost $14,000 gained in his first year. To put that in perspective, a high-yield savings account paying 5% would give John about $5,000 in that same year. VOO nearly triples that, and that's just year one. After 10 years, John's portfolio is projected to grow to $354,776, more than triple what he started with. And he hasn't done a single thing extra. But here's where it gets interesting. Watch what happens in the next 10 years. At year 20, John's portfolio is valued at $1,211,788, a millionaire status. And now the final 10 years. This is the part that breaks people's brains because the math starts working so hard in this last stretch that it almost doesn't look real. At year 30, John's $100,000 is projected to be worth $4,060,125. And look at that acceleration. In the first 10 years, the projections showed John gaining about $255,000. In the second 10 years, about $857,000. But in the last 10 years alone, from year 20 to year 30, his portfolio grows by $2.85 million, more than the first 20 years combined. That's roughly $285,000 being added per year in that final decade, almost $24,000 a month. And the reason it grows this fast at the end is because compounding doesn't work in a straight line. In the early years, John's returns were being calculated on $100,000. But by year 20, those same returns are being calculated on $1.2 million. The percentage doesn't change, but the dollar amount it produces gets bigger and bigger every single year. So by that final decade, the same growth rate that gave John $14,000 in year one is now generating hundreds of thousands of dollars per year. The money is making money, and that money is making even more money. That is the compounding snowball at full speed. This is why people say time in the market beats everything. Because the real money isn't in the first 10 years. It's not even in the second 10 years. It's in that final stretch where compounding goes from working for you to working overtime. Where did all that money come from? Well, John put in $100,000. He's projected to reach $4,060,125. That means VOO generated $3,960,125 on top of what he started with. Out of that, $3,871,585 came from pure capital appreciation, the stock prices inside VOO going up year after year, and $88,540 came from reinvested dividends, a little extra fuel on top of the fire. Every single dollar John invested created almost $40 in returns, 40 to 1. That's not John working for his money. That's John's money working for him. Want to know how a simple $5 a day investment can grow into a portfolio that pays more than $8,000 a month in dividend income? Click the video on the screen to find out.